Okay, let's unpack this one. We're doing a deep dive into Figma, ticker FIG.
And it's a real paradox of a company.
It really is. I mean, when you look at the books, this is an elite business. We're talking over $1 billion in annual recurring revenue.
And a net dollar retention of 131%. I mean, those are software titan numbers.
Exactly. And yet the stock is trading down, what, 73% from its post-IPO high? It's sitting around $37.36.
So for you, the listener, who we know has a high cost basis and about $20,000 in dry powder, the mission is pretty clear.
Is the long-term thesis still intact? And if it is, how do you even begin to build a strategy around this kind of volatility?
It's a great business with an atrocious stock chart. So before we get into why it crashed, let's just establish why we're even calling it an elite asset in the first place.
Yeah, what's so strong about the fundamentals?
Well, what's fascinating here is just how strong they are. Figma is a rule of 40 titan. They've got 38% year-over-year growth paired with phenomenal profit margins.
And for anyone who doesn't know, the rule of 40 is that signal of a really healthy SaaS business. Growth and profit imbalance.
Perfectly balanced. And that 131% net dollar retention, that's the key. It tells you existing customers are spending more and more.
So they're not just adding in new users, they're expanding with things like FigJam or DevMo.
Exactly. The product is sticky. Which brings us to the main conflict.
Why is this thriving business getting destroyed on the market?
The first piece is the structural noise after that July 2025 IPO.
Right. It had that huge run up to almost $143 and then just cratered.
That was pure euphoria, not fundamentals. But the real catalyst for this recent drop was a huge structural event.
You're talking about the lockup expiry.
The November 2025 primary lockup expiry, a deluge of supply. Hundreds of millions of shares from insiders and early investors all hit the market at once.
And that just slammed the price down.
It did, but what's interesting from a technical perspective is the recent steadiness we're seeing, in that $35 to $37 range.
So you think that massive supply might finally be getting absorbed by the market?
It suggests what we call lockup exhaustion. It's often where you find a durable bottom once all that early money is done selling. The critical line to watch is the 52-week low,
which is at some $2.83.
If it holds that, the worst of the technical pain might be over.
Okay, but even if the technical noise settles, that doesn't address the existential threat looming over the entire design space.
You mean AI?
I mean AI. This whole concept of vibe coding, how real is that risk?
It's the true long-term risk. It's what we're calling the AI pincer.
Because tools like V0 are experimenting with generating UI directly from a text prompt.
And that threatens to bypass the entire design phase that Figma currently owns and monetizes. It could literally shrink their addressable market.
So the designer gets cut out of the initial workflow. Figma's defense here is what, Dev Mode and Code Connect?
It's a strategic pivot, yeah. They're trying to position themselves as the essential source of truth for complex design systems. So even if AI generates the first draft, the real work, the governance, still happens in Figma.
But they're not just fighting AI, are they? There's also Canva.
And the Canva threat is very, very real. They bought Affinity, and now they're weaponizing their huge user base.
By making pro-grade design tools basically free for enterprise clients.
Precisely. That puts immense pressure on Figma's pricing power, on their ability to charge a premium.
Okay, let's talk about the big red flag here.
Yeah.
The one thing that just crushed investor sentiment. The insider selling.
It was bad when your CEO, Dylan Field, sells over $112 million worth of stock in a single week in November.
It's a massive blow to confidence, especially when the stock is already so beaten down.
It just sends a terrible signal about internal conviction that selling has to stop for any kind of sustained rally to begin.
So let's synthesize this. We have elite fundamentals, but we have huge competitive threats and these structural selling issues.
So for our listener, with that $20,000, what's the actual concrete plan?
What's the move?
We're recommending a speculative accumulation, and we have to stress the high-risk part of that.
So don't go all in.
Absolutely not. Since you already have a high-cost basis, the goal is to average down slowly. I'd say dedicate only half of that dry powder, so $10,000 for now.
And how would you deploy that?
Use a dollar-cost averaging strategy. Split it into 5 tranches of $2,000 over the next, say, 3 to 4 quarters.
Are there specific price levels you're targeting?
Yes. You'd want to buy heavily if the price retests that critical $33 support level. That's your best risk reward.
And on the upside.
The other buy signal would be a convincing break above $45. That would confirm a real trend reversal. But and this is crucial, set a hard stop loss.
Where?
If the stock closes below $30 on high volume, you cut bait. The thesis is broken at that point.
So, boiling it all down for you, Figma is a generational company, but it's enduring a really painful public market transition.
Right. And that technical base that seems to be forming is the first real glint of hope. Accumulating slowly respects the very real risks from AI and Canva, but it also positions you for that potential 3 to 5 year recovery of a premier asset.
So the ultimate test isn't the lockup expiry.
No, it's whether their design system defense can actually monetize the new era of generative AI. That's the whole ballgame.